Many investors saw their portfolios hemorrhage today as their favorite growth stocks dropped 5–10%, even more in some cases, based on the latest news from the Federal Reserve. Is there more pain to come? Could this be the start of a stock market crash? I'm going to talk about these questions and more in this video. If this is your first time tuning in, my name is Daniel, and you're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice. And so what happened today? So earlier today, minutes from the Federal Reserve were released, causing a quick drop in the stock market. This was because the tightening they were considering in response to nearly 10% inflation was faster and stronger than many investors expected. This is actually a really big deal for several reasons. We're going to talk about that in just a second, but you should first understand they were way off and they've been way wrong for a long time. They've been talking about transitory inflation, got way hotter than they expected. And so this is a course correction that you're looking at. And it's not only a course correction, they might have to move faster than they previously expected. And that's the shock for the stock market, because previously, the idea of a rate hike in March was a little bit earlier than folks were expecting, and that's what's being alluded to right now. And now also considering unwinding their significant bond portfolio. And keep in mind, this is unwinding the $120 billion a month that they've been buying of Treasury and mortgage-backed securities. So they could go from a huge buyer to a huge seller. So this is a huge deal for several reasons. So one is the impact on the real economy. As rates go up, if you're a seller of Treasury bonds, that means rates go up. So economic demand really gets impacted, because keep in mind, demand has been significantly juiced this past decade by artificially low rates and increasing amounts of debt. So any rise in rates will hurt demand. And ultimately, if demand gets hurt, which is reflected in the top line for businesses or their revenue, that hurts businesses and then their stocks. And stocks are generally actually forward leading or forward, indicators of what the actual economy will do. So not only do businesses report worse results, but their valuations also get squeezed. With higher rates, on risk-free bonds, the appeal of getting an extra return from taking a gamble on a stock is less appealing, because now you have the uncertainty of, will this company actually perform? And so folks might start drifting into the appeal of risk-free bonds. That reality, however, is that the interest rate trade-off that you see with wait a second, maybe you get 1.5% as opposed to 1.3% on a Treasury bond, that's not the real thing that pushes valuations lower, in my opinion. What really does it is the change in liquidity. What's that? So the Federal Reserve has been one of the largest market participants in the last few years in the world, and their reversal from being a buyer to being a potential seller has huge ramifications. In the short term, liquidity drives prices. In the long term, fundamentals drives liquidity, as investors look for, hey, where can I get my best return for the capital that I have? But in the short term, it's okay, let's create more capital, and that change in capital sloshing around, that's ultimately what drives prices. If you have a huge increase in liquidity, that's going to influence prices higher. If you start pulling a lot of liquidity, that will influence prices lower. And so the Federal Reserve saying, yeah, we're pulling the liquidity out of the market here, that's a big deal for stock prices. And the change in liquidity and pricing ultimately drives another key component, which is sentiment. And this is the key reason why many of these unprofitable growth stocks are and may continue to get pummeled, in my opinion. Mr. Market swings from optimistic to depressed. And many of these unprofitable growth stocks have huge multiples of price to sales, and they're valued on margins they're nowhere near achieving. This is a really important point for folks to consider. These really, these fast growth companies that are unprofitable, that trade at 20 times sales, 30 times sales, more, they're valued on future margins that they're nowhere near achieving. So if Mr. Market turns from, let's say, optimistic into a skeptical investor, it doesn't matter how fast you're growing if you're not profitable, because Mr. Market swings, the sentiment changes. It's now skeptical. It now says, hey, I want cash flow. Valuation multiples in that situation can contract way lower than folks expect, unless management is clearly on a path to much higher margins. One instance, I think about Shopify a lot, because they've been a huge beneficiary of sentiment change and valuation multiple expansion. Just a few years ago, their valuation was, single-digit price to sales multiple. That is a huge discount from where it currently trades. I mean, if it were to fall back to that, you're talking about huge declines. And that's what I'm thinking about for a lot of these growth stocks. Why is it that many of these growth stocks were previously trading at single-digit price to sales multiple? Why can't that happen again? That's important for you to think about. So what do investors really want when sentiment changes? They want real value. They want real cash flows. Who's the king of value and cash flows? Warren Buffett, I'd argue. And Warren Buffett's Berkshire Hathaway made a new high today because investors are treating it like a flight to safety because they know he's always been focused on real cash flows. This is while many growth stocks were down 5 to 10% plus. I've also seen this across my own personal portfolio where my unprofitable hyper growth stocks, those were the ones that absolutely got pummeled. Whereas my, companies that are more of a value orientation, trading below book value or trading at 10 times free cash flow, those were the ones that largely held up in this market. Personally, I look at Berkshire and while you do have this flight to safety going on, I am skeptical that can continue significantly. Like it's always possible Berkshire Hathaway continues to rally, don't get me wrong. But if you have, let's say, a market completely fall apart or a market crash, Berkshire Hathaway, I'd be very surprised if it continues to make new highs. Because look, at the end of the day, they have their value is a portfolio of companies and their underlying operating businesses. If the economy hurts their operating businesses, that'll hurt the stock. And, Apple, for example, is a $100 billion plus position for them. If Apple stock declines, that's a real hit to their intrinsic value. So how much more pain is there to come? First, a quick plug. Where if you're interested in joining a community of fellow investors looking to learn and find exceptional companies, we have an exclusive community on Discord where I interact almost daily. You can sign up at unrivaledinvesting.com, click join the journey. I also call potential multi-baggers and share my own personal portfolio for those interested. If you enjoy videos like this, please make a point of hitting that thumbs up and hit that subscribe button as well. So thinking about how much downside is there, how much more pain is there, could this be the beginning of a stock market crash? It's very clear that studying past market cycles that the tops are made when the Fed starts tightening liquidity. Might not be right away. It might be after a few more rate hikes. So it's possible you continue to have some sort of rally. You get some sort of rally from here, maybe a bear trap. But the bottoms are really made after you have a real collapse and you go through a real Fed tightening, you go through a real tightening cycle. The bottoms are made after the Fed reverses course. After the government reverses course, either the Fed or you start seeing effectively fiscal monetary spending, fiscal and monetary stimulus going on. So the bottoms are generally made when liquidity starts flooding the system by the Federal Reserve, by the central bankers and fiscal spending. And so we're nowhere near that in the U.S. as the Federal Reserve just started the tightening cycle. They didn't even really do it. They've just been talking about it. So we are at the polar opposite end of what I'd argue is the bottom that you'd see in this cycle. It's also worth calling out how many growth stocks continue to trade at historically extremely elevated valuations. This gets back to that risk I was calling out a minute ago. These companies, and I've called out, be cautious about this. I did a video on Palantir where I was like, should this warrant caution? This is a company trading at 25 times sales, even after it sold off today. It's being valued on margins of 30 to 40%. They're unprofitable, folks. And folks say, knucklehead YouTubers go, oh, this is ridiculous. This stock's so cheap. You don't understand. Well, wait a second, folks. What if sentiment changes? What if you have the Shopify valuation that you got just a few years ago? What if this all of a sudden gets 4 times sales, 5 times sales, 6 times sales? So what happens if you get something like that versus the 25 times sales? So I would argue, if you want to think about, could the stock market crash? I'd say absolutely. Could you see a lot of pain from here? I would say it depends on individual securities. And the growth stocks that trade at 20 times plus sales, it would not surprise me to see many of these continue to drop. Even if they've already dropped significantly, it wouldn't surprise me for the ones that are trading at, let's say, 20 times sales plus. It wouldn't surprise me to see a 30 to 50% drop within many of these names within the next 2 years. And that's just my personal call based on looking at wait a second. A lot of these valuations I've called out, these are based on giving full credit to margins these companies are nowhere near achieving. If you have a change in sentiment, that's in addition to the change in liquidity. Liquidity makes it worse. If you have liquidity and a change in sentiment, well, all of a sudden investors go, oh, okay, I'm skeptical. I want to give a discount to this. I'm assuming a discount that they will not actually achieve these margins. Then you can get really hammered. And that's my concern with this broader market. I'd argue that's arguably what happened when you know, a lot of folks like to go, well, wait a second, this is, you know, this, you would have missed out on Amazon, that type of logic. But the reality is Amazon stock dropped 90% in the dot-com crash. And it's because of this very aspect where folks were assigning a margin that they hadn't yet achieved. And when you have that situation, you can have increased investor skepticism, where they say, wait a second, what's the actual future margins for this business? And if investors aren't sure, then you can have drops that are way worse than investors expect. And I'd say be cautious here for a lot of investors to consider. I'd say if for your individual holdings, know what you own. Make sure you're penciling out a reasonable valuation. Look, in fairness, I own a few things that are around price to sales multiples of 20 times. I recognize it. I do own it. It's not like I'm saying, oh, I'm completely out of it. But I also recognize those names, as I saw today, those are the ones that have been getting hurt the most. Whereas the value-oriented, the ones with real free cash flow, those are the ones holding up the most. That's at least what I've seen today. And you saw it with Berkshire itself, as I called out. So if this video has been helpful for you, I really do appreciate that. Subscribe, hit that thumbs up button. Thanks so much for tuning in.